Thanks everybody for joining. This is Quinn Arnold, and with me today are Matt Hilland, and Matt is one of our planners with the firm. You may know that we do these webinars monthly as a way to connect with our clients on a kind of deeper dive topic than what we frequently can get into in a meeting. So we take these ideas from you, the clients, because we always know that you have some things that are interesting and timely and relevant to your financial lives. So please continue to send these kinds of topics in. Today, Matt will be talking about some kind of an annual review type information, which is something that we may do with you in a meeting, but is also something that you can consider looking through on your own with your own life insurance and long-term care insurance policies. But Matt will get into the specifics of that. So I will be watching the chat if there are any questions during the presentation, and then this presentation will also be recorded and available for reviewing later on the website. And so if you have any questions, please send me or Matt an email. And with that, Matt, I will turn it over to you.
All right, thank you. And yeah, just to echo Quinn, thanks for joining us today. We're going to look at a few examples that we've just seen either personally or from clients on different types of life insurance, how to think about whether or not these policies are still appropriate, if they're still the right option for you. And then one just disclaimer is that, there's a kind of numbers or a mathematical way to look at insurance. You need this amount or you don't need this anymore, but insurance is also just a very personal decision too. There's nothing wrong with wanting to be a little overinsured as long as you kind of understand what you're paying for, and there's still just making sure you have the right policy for you. So we're going to kind of get into a lot of the different types of insurance, both life insurance and long-term care insurance, and help you just make sure that what you have or what you're looking for is still the right option for you. So just to start, why is it important to review your insurance policies regularly? First of all, a majority of Americans have some sort of life insurance. So this is just a topic that we know impacts a lot of people. And it can be a pretty significant expense, especially if you're looking at some of the permanent life insurance, like whole life or universal life policies. And long-term care insurance in particular is just can be very expensive. And so if you're paying for insurance that you don't need, that's a lot of money that's going towards something that's maybe not giving you that great of a return. And it's also something that tends to just be put in place at one point in time and then rarely looked at again. Maybe you bought that term life or whole life insurance policy 30 years ago, and you just keep paying the premiums and never really look at it again or think about it again, in the future. And so this leaves room for opportunities for you to review these policies because in general, your insurance need tends to decline over time. When you're 30 years old, you have a lot of future expenses to cover. There's a lot of potential loss in income. And so for most, in general, this is when you have your largest insurance need, kind of early in life. And then as you age, as you work, as you save, you have less and less future loss of income you need to protect against. Your savings builds up. That gives you or your spouse a source of funds that they can use to make ends meet, if something were to happen. And so this general concept works for both life insurance and kind of long-term care insurance as well, as we'll look into. And so regardless of whether we're talking about life or long-term care, if you haven't looked at some of these policies that you have for years or even decades, there's definitely some potential value in spending the time to review this. And then, of course, just besides that, obviously a lot can change with your plan over the years and decades. And so when you purchase that term policy or whole life policy 15 years ago, it very well may have been, the perfect policy for you. But now you've received a promotion at work, or you've increased your savings, investments have done very well, you have different employer benefits. a lot of things can change over the course of the years that make what was a very good policy just not the right fit for you now. And so I think you get the point here. There's lots of things that can change, and if you've had a significant change, for sure, that's a good time just to trigger something in your head that it's time to review your insurance. And so starting off with just kind of the most simple insurance, just term life insurance. This is just insurance that provides a set benefit for a certain number of years for a certain premium. And sometimes that premium's fixed, sometimes it isn't. We'll look at some examples later, but there's really not a lot of variables to analyze here. This is not a complex calculation here. You're really looking at just two main items. First, that's the term or the years that are left on the policy, and just is that still appropriate? If you have, again, increased savings, you might not have a need for insurance as long as you initially thought you would. The option is available to you to just stop paying on this policy, save yourself the premiums, knowing that the savings that you have is kind of your new insurance policy, so to speak. Or maybe you need insurance for a longer term. Maybe you had another child, maybe you took on debt later in life that just led to a larger insurance need. There can certainly be scenarios where you need to add insurance later in life. And it's important to recognize that need earlier on, just because life insurance costs increase as you age. And so if you know that you are underinsured, it's probably going to be much more beneficial to address that now rather than later. And then one other variable we like to make sure you're thinking about is if you're still working and have employer provided benefits, make sure that that's kind of in your plan. This, a lot of times just kind of gets forgotten about since the employers might be paying for this benefit. And, if you're later in your career, you might be at one of your higher salaries that you've had in your lifetime. That 1 or 2 times salary benefit could be a good amount. And so knowing that that employer provided benefit's going to be there can be a really good just kind of stepping stone for getting people to surrender some other insurance that they don't need and still know that there's something there just in case. Can give you the confidence to maybe get rid of some of those unnecessary policies that you might still have. And, just a quick plug, this is something that's easy for us to help you with. We can perform what's called gap analysis to look at what would happen to your plan if you or your spouse, if something were to happen. So some charts, some analysis looks something like this. What would happen if you don't have any insurance, and then what amount is needed to kind of plug that hole and make the plan still successful, even if something were to happen to you. And then just one last item on term insurance that we wanted to be sure to address, and that's what's called annual renewable term. From my experience, this is marketed pretty heavily from some of those bigger insurance companies. We're going to look at the details of a quote I received when I went behind enemy lines here to Northwestern Mutual to get a quote just to kind of see what their process is like. But you'll see something very similar from a lot of different insurance companies out there. And the big difference here is that the premiums are not fixed, like level or like most of the term policies that we'll look at with you. These premiums can be variable. And so they tend to start low, but increase over time. And so just for example, what we're looking at here on the right is the details of the policy that I got quoted. This was for a $250,000 benefit. And what's important to notice here is that there's 2 columns on the right-hand side showing the potential premiums over time. There is a guaranteed amount, and so that is what the insurance company guarantees your premium will not go over a certain time. It begins here, in this case, $179 a year. And then, as you can see, can drastically increase over time. And so, it might be as much as 5 times higher 14 years from now. And this increase will depend on a lot of different factors over this time frame. How well they were or how accurate they were able to underwrite, performance of investments, inflation, and so on. But just what's important to realize is that with these policies, there's a huge uncertainty about what your premium will be in the future. You'll see there's also normally going to be some kind of non-guaranteed premium also. This is kind of their optimistic scenario, what your premiums would be as long as everything goes, according to plan. In reality, you can expect something probably in between one of these. And so the chart that I graphed here is just showing the annual premiums of this policy. So in blue is the guaranteed amount. This is what you're guaranteed not to pay more than this. In yellow is kind of their optimistic scenario. And then in green was what I got quoted for a level term policy. So this means the premium had to stay consistent, and that was $220 a year. And so you can see that initially both of these annual renewable policies that I was quoted were initially cheaper, but then over time that will increase and eventually become more expensive. And both of these scenarios for the annual renewable term end up being more expensive than the level term premium in this case. And so if you have one of these types of policies, it's just a good thing to ask yourself, does this still make sense? Is it worth saving some money potentially early on for a potentially much larger cost in the long run? And also, if you're in one of these policies before this premium has started to increase, it might be a good time to at least price out a level term policy, kind of lock in lower rates, and avoid yourself kind of the uncertainty of not knowing what's going to happen with your premiums and your benefits. Now onto permanent life insurance. So this is kind of any variation of whole life or universal life insurance. It's called permanent life because as long as you continue to pay the premium or as long as you pay a minimum amount into the policy, you're always going to have some kind of insurance benefit. And so these are marketed very heavily. Agents are highly incentivized to sell these types of policies. And then they're also often pitched as a way to combine, savings and insurance all in one product. They build up some kind of cash value that they'll say you can borrow against and can be kind of the savings account. But it's just important to realize, first and foremost, these are an insurance product, a savings product second, and a very distant second at that. And so if you don't need life insurance, the fact that you can kind of save into these is not going to make them useful or worthwhile just on their own. And so right away, I hope the idea of permanent insurance highlights a big difference from that chart that we showed on the first slide, just showing insurance need declining over time. Permanent policies tend to do the exact opposite. And so you have lower insurance amounts earlier on, and then increased amounts as you continue to pay into this policy, as the underlying investments of the policy, grow. And so just for example, on the right-hand side here is now the whole life policy that I was pitched when I went in for a quote on term insurance. Again, these are heavily marketed. They wanted to make sure to get this in front of me. And so remember, for a 20-year level term policy, I was quoted $220 per year for $250,000 in benefits. Now with this whole life, I was quoted an annual premium of $3,250. That's this far right column here. For an insurance benefit that would start at $234,000. And so, right away, I hope you see about $3,000 more per year in costs for less insurance early on in the plan. And then over time, as long as I continue paying in that $3,250 a year, my insurance benefit was going to increase so that by the time I was 65, this policy, they project would have a death benefit of about $489,000. And of course, the asterisks up here all point to some fine print that says none of this is guaranteed. It depends on, the performance of your investments and so forth. But you could be pretty confident with this type of policy that this death benefit would increase in some extent over time. But regardless, this policy is going to function quite differently than the term policies that we just discussed. I get less insurance early on, which in my case is actually when I needed life insurance, by the way. And then now I have a lot more insurance later on when, as long as I continued on the plan that, saving, I won't need later on. And so it also costs $60,000 more over the course of my life for this insurance compared to the term policy as well. And so, all this kind of comes together to be, I think, a good example of how for a lot of our clients, again, not everyone, but for a lot of people, these long-term permanent policies just tend not to make as much sense as some of the other options that are available. And again, this is a whole life example. There's also universal life, which tends to have lower premiums, but much more variability in the benefits and the premiums. And for those, if you have a universal life policy you haven't reviewed in a while, a really good first step is to request an updated, what's called a policy illustration, or sometimes called an in-force illustration of the policy, to see how it's performing, how it's projected to perform in the future. And that illustration is going to look, it's going to be many pages long, but in there is going to be a couple tables that look something like this. And so there's a lot of numbers here, but all this is showing you is that the premiums that you pay over time to keep this policy active, in this case, about $9,100 per year, any projected cash value that the policy builds up over time, and then the death benefit. And so these policies can be structured a lot of different ways. These can get pretty complex. So sometimes you're going to see the death benefit increasing. Sometimes you're going to see cash value increasing a lot more. Sometimes the premiums are just required to be paid for a certain amount of time. So in this case, as long as they paid that premium for 20 years, the death benefit's guaranteed. Sometimes that's not the case. But just know that these numbers might look a lot different, but this in-force illustration is going to give you kind of the details that you need to analyze or help us analyze whether or not this policy is right for you. So this is something we received. This was for a household that were very good savers. They had a cell phone business that was doing very well. They were maxing out individual 401ks, building up assets pretty quickly. But they did have a short-term insurance need just because of some liabilities in the business. So if the parents passed away, the kids were going to inherit the business. They wanted to make sure there was some money, left over. So early on, there was money there to help kind of pay down the liabilities for the business. And so they went to an insurance company and received this quote. So over the course of 20 years, they were going to pay about $182,000 in total premiums, about $9,100 per year, for $500,000 in death benefit that paid out only once both parents passed away. This was a joint universal life policy. So nothing really happened if one spouse passed away. Both have to pass away before this pays off. And so, a few things jumped out to us right away. First, their need for insurance was really early on in the plan. As I mentioned, they were saving really well, business doing very well. There was an insurance need in this case, but it was in kind of this earlier period, maybe the first 20 years here. It was not much later on, because if everything goes according to plan, 25, 30 years out, the savings that they were doing was going to more than make up for this kind of need for a death benefit. And so we got a term insurance quote for them as well, 20-year terms. The premiums for both the spouses were about $3,000 per year. So a savings of about $6,000 per year for $500,000 in benefits for a 20-year term policy. And so, you can receive, in this case, they could receive that death benefit of $500,000 for that 20-year period and save about $6,000 per year, or about $120,000 in premiums, which was pretty significant. And then, so why this also got pitched to them was that it's a long-term investment, so to speak, per the agent here. And then notice the far right column of this illustration. What it shows is that the return, or the IRR, of the premiums based on the death benefit. And so, just for example, in year 20, this household had paid $9,100 a year, a total of $182,000. If both spouses die at year 20, they would have received a return on their premiums equal to about 8.85% annual return. Or maybe just saying another way, if they invested this premium instead of buying an insurance policy, they would have had a return of 8.85% to match the return of this insurance policy. And what I think is kind of unique about these permanent insurance policies is that their return tends to decrease over time. So they're marketed as being permanent life insurance that's always going to be there for you. But the value of that insurance benefit decreases over time compared to the premiums that you were putting in. And so these policies just end up being a very expensive way to insure yourself early on in your plan. I mentioned about $6,000 more per year for that death benefit. And then they end up being very expensive, really just producing a return, about equivalent to a bond today over the long term. So you could argue, you're tying a ton of money up into these policies for not that great of a return. So there can be use for these policies, but we just wanted to show this because we thought this was a good scenario to kind of show how you should compare this against other insurance options, and just an example for why we see these as tend to not making a lot of sense for a majority of our clients out there. And so if you have one of these permanent insurance policies and determine that it's no longer needed or appropriate for your situation, you have a few options. You can just surrender the policy, even if there's no cash value built up. At least surrendering saves you from, paying the premiums for something that you don't really need, which, as we've seen, can end up being pretty significant premiums. And then if there is some kind of cash value that's built up, that can create some tax liability if you surrender the policy. A portion of that might be taxable. But there's also some very valuable tax planning we can do around this too. And so maybe you're retiring and next year your income's going to be very low. Well, now the tax liability on that cash value is going to be pretty low, and you can get that out with very little tax impact. Maybe you're doing large charitable contributions that you can offset this tax liability to. So there's a lot of opportunities to access that cash value without, as big of a tax hit to you. And then there is also ways to exchange these policies tax-free as well. This might be useful if you have a very large cash value that's built up and you can find a different policy that has features that are more appropriate for you. So maybe you can find a policy that has long-term care insurance benefits, maybe one that provides just a more appropriate benefit amount, gives you better access to withdrawal or access the cash value, lots of different things, but that is something that might be worth considering if you have a large cash value, or it just doesn't make sense tax-wise to kind of surrender that policy right now. So that was a lot on kind of different life insurance. Now we're going to move into long-term care insurance. And so this tends to be, life insurance tends to be something purchased earlier on in the plan that becomes less useful later. Long-term care insurance tends to be something purchased, later in life, in your 60s usually. And traditional long-term care policies are pretty straightforward. You're going to pay a premium, though that premium's rarely fixed, like some term insurance we were looking at. But in exchange for that premium, you're going to receive a set benefit, usually some benefit, some inflation rider on that benefit, and some like max payout that the policy will offer. And for any of you who have this type of insurance or have shopped around for it, you know that it's expensive. And so just like with life insurance, the big question to ask yourself is, do you still need this insurance? And so it may have been very smart for you to buy this policy when you were 60 years old. You're at a larger risk then for if there was a long-term care scenario, your plan was more at risk, but maybe you're 75 now and have been healthy, your savings have done well, and you might be in a position where now this long-term care policy is just not needed. And you can be much more confident in self-insuring because, there's less time horizon to worry about, your assets have built up, you have ways to pay for a potential long-term care scenario yourself. And also, like life insurance, the need for this type of insurance can decline in time. Again, just because if you go your first 20 years in retirement and do very well, you'll probably be in position to be able to weather, some long-term care expenses. And then where these are also seeing a lot of attention from our clients is that these policies, and particularly if you purchased a long-term care policy many years ago, have seen big increases in their premiums. And so they were just, not priced correctly early on. A lot of insurance companies lost money on these. And then if different insurance departments agree, they're able to increase the rates on these insurance. And so they're passing a lot of increased costs on to clients. And so another scenario you might be presented with is, maybe you still know you want this insurance, but the insurance company will present you with some options where, for example, the image shown here was one that a client received. They were paying $3,100 a year for a long-term care benefit that had a maximum benefit of about $275,000. This premium was increasing pretty steadily. And so the insurance company offered a few different options, but just to show you some potential options you might be given, they were given the option to never pay in anymore into this policy. So your annual premium is now $0, but your max benefit is reduced. So from that $275,000 to $98,000. This gives us just very concrete numbers we can plug into planning software and see if this makes sense. Has this person's assets increased enough where if they have a lower amount of coverage, they're still good, or do they still need, this larger amount of coverage? That $3,100, not fun to pay, but it's worth paying maybe for that, more than double, almost triple increase in benefits. And so this gives us some very concrete numbers that we can get back to you on and say, yep, this makes sense. You might see a few different options too. They might just offer to reduce the inflation benefit. And again, that gives us a good concrete numbers to compare. If you have a good enough benefit, maybe you don't need any more inflation, on that. You can save on premiums to just kind of lock in your total lifetime benefit now. Or again, like we saw, they might reduce maximum benefits. They might reduce your daily benefit, increase your elimination period, a lot of different things. But just know that with these policies, we're seeing this pretty actively with clients who have long-term care insurance policies. And then as you analyze whether or not this insurance makes sense for you still, a good thing to check, Genworth is a big long-term care insurance provider. If you look at the Genworth cost of care survey, if you just Google that, it'll come up right away. You can plug in, your location where you live or where you think you're going to be in retirement, and it will show you the average cost for different levels of long-term care. This gives you just kind of some good numbers to know to plug into your analysis and say, okay, I know I'm going to retire in Cedar Rapids. if I need nursing home, it's going to cost between $80,000 or $90,000. Can I afford to pay that? And is then that long-term care insurance policy worthwhile to give me, a certain amount of coverage? This information from Genworth is just going to be really helpful in identifying the value of that policy that you have. And then lastly here, we just want to cover, there's also something out there that we just call hybrid long-term care insurance. And what this is a long-term care rider on top of some kind of permanent life insurance. And so it might be, guaranteed universal life that has some of the death benefit that can be used for long-term care before you pass away. And so in general, we have not seen these be that attractive of options for clients. Again, I'm sure there can be a scenario where it makes sense. But in general, they tend to be very expensive upfront. They either require a very large upfront premium or very high annual premiums for just not that great of long-term care benefits that maybe more importantly don't have any inflation adjustments on them, and also requires you to be paying for life insurance. And so if you don't need life insurance, it just tends not to be a good option because a lot of your premiums also going to this life insurance that you may not need. So shown here is an image from a client, a quote that they received for this type of insurance. They were in their mid-50s, and the quote was for they had to pay $50,000 right now as kind of an upfront payment. And then in exchange for that, they received $96,000 in death benefits, plus there's an additional $96,000 that could be used for long-term care coverage somewhere down the line. And so, what we would look at here is this client was in their, again, mid-50s, still looking at quite a long ways before that death benefit was likely to be realized, and even that long-term care need was going to be there. Putting in $50,000 when you're 56 and receiving, potentially $96,000 many decades down the line is, in our opinion, really not that great of a return. This client also really had no need for life insurance either. So that, this part of it was almost, worthless to them, just because they had enough savings built up elsewhere. They were young, relatively young, healthy. The return on that $50,000 is pretty low if you're just going to receive $96,000 many decades down the road. There's a pretty compelling argument, in this client's case at least, to just invest that $50,000 as part of your normal asset allocation and receive hopefully a much bigger benefit later on. But again, because these are kind of complicated insurance products, they get marketed pretty heavily. We wanted to make sure that, we kind of address this type of insurance. In general, though, traditional long-term care insurance, in our opinion, just seems to make more sense for most people. But if you go shopping out for a policy, you'll probably also be given, some kind of quote with a hybrid policy too. So just a few things to keep in mind. That's all that we had today. Please let us know if you have any questions. Either, here, if you don't mind saying anything in front of the group, or we're available phone call or email after. And if we don't talk to you before the holidays, have a very happy holidays, and thank you.